I'm Williams. We're going to be looking at capital structure theory today. We already know that we fund our business either by debt or by equity. Given that we fund our business either by debt or by equity, is there any perfect mix of debt and equity that will maximize the value of our company? We already know that for us to estimate the value of
a company normally is equal to the cash flow per annum divided by the WACC. Now, what I want to know is this: is there any way by changing my capital structure I can affect the WACC, I can reduce the WACC, or even increase the WACC? For example, if I'm able to increase the WACC, I could reduce the total market value of the company. Or more importantly, if I was able to reduce the WACC in some way, that will increase the market value of the company. In fact, if I can minimize the WACC, I can maximize the value of the company. That is the first basic idea of capital structure. Always remember this point when starting with capital structure theory. Now, please know that there is an inverse relationship between the market value of a company and the WACC. What does that mean? When I mean there is an inverse relationship between the market value of a company and the WACC, is that a decrease in WACC will lead to an increase in the market value of a company, while a decrease in WACC will lead to an increase in WACC will lead to a reduction in market value of the company. Now, the next point should be on the impact of introducing debt finance, which I'm going to throw light on now.
In the introduction of impact of debt finance in capital structure theory, the idea of introducing debt finance in capital structure theory. There are two effects when we introduce debt finance in capital structure theory. The first one is called the financing effect, and the other part is called the financial risk effect and the substitutional risk effect. For that of the substitutional effect, it's talking about it has two side effect, which is one, it reduces risk to the debt holder, and it is tax deductible because of the interest. What I want to say is that when we introduce debt into the capital structure, we will expect the WACC of the company to fall, and if the WACC of the company fall, we expect the market value of the company to be maximized. So when we reduce the WACC or increase the WACC, it has impact on the market value of the company, since there is an inverse relationship between the WACC and that of the market value. What am I trying to say? When we introduce debt finance, we are expected to reduce the cost of equity in proportion to the amount of debt introduced into the capital structure in order to maximize the value of the company. So when we increase the WACC, we expect the market value of the company to fall. That was why I said there's an inverse relationship between the WACC of the company and that of the market value of the company. This is the first basic idea in terms of capital structure theory when we introduce debt finance. Then we look at the financial risk effect.
The financial risk effect. Because when we talk about the financial risk effect, this is a situation whereby an increase in cost of equity will lead to financial risk effect. This is simple. This is by taking on debt, the company increases its chance of default, liquidation, failure. If that is the case, if there is a higher risk to the company itself will have to offer a higher return. When we look at the risks associated with default, it is almost completely suffered by the shareholders, and the shareholders being the key risk takers. Therefore, the financial risk effect is that there will be an increase in cost of equity as a result of taking more debt. That is why more companies prefer going for the substitutional risk effect, which is whereby they introduce more debt finance into their company in proportion to the amount of cheaper equity in order to make the WACC to fall. Now, one thing we should know that an increase in risks will be suffered by shareholders, and as such, we will expect the KE to rise, and as the KE rise, we will expect the WACC to rise, and when the WACC rises, we expect the market value of the company to fall. Whatever we do affects both the WACC or the WACC rising or the WACC falling. So when we take on substitutional risk effect, we expect the WACC to fall. When we take on the financial risk effect, we expect the WACC to rise, and when the WACC rises, we expect the value of the company to fall.